Hello everyone, my name is Quinn, bringing you this MarketMaker.io Bitcoin market update. Please take a moment to read the disclaimer. Remember, nothing in this video should be construed as financial advice. So let's get right into things. I'm talking about Bitcoin first and how it's been ranging between around $33,000 to just under $46,000. It did make another attempt last week, as we saw, to get near the top of the range on the back of some positive news on Bitcoin regulation, or crypto regulation I should say, in the United States. Most analysts think that the message from Biden was that the heavy-handed approach to regulation that many were fearing does not seem to be bearing out, at least so far. In the bear case, looking forward, we have to acknowledge that most of the short-term holders who are responsible for the swings in the range did buy their Bitcoin at around $46,000, which means that right now they are still underwater. And in a multi-month downtrend, until we see a significant break in the bullish scenario, of course, if we did see a break, perhaps on the back of some type of positive news flow for Bitcoin. Otherwise, the risk of a rejection here, if it were to make its way back up to the range, still looks quite likely. So moving on to this Dixie chart again that we talked about previously. We talked about how it could be facing a possible decision point here if it were to get rejected or to break out of this trend. So right now, the rejection scenario is still looking possible. If the Dixie were to weaken, it would definitely help breathe some life into risk assets or assets in general, at least temporarily. And something to note with the upcoming Fed decision, right, is that historically there has been cases where the clarity brought by the start of a tightening cycle has been enough to get the Dixie to weaken. But with the current situation geopolitically, we have to acknowledge that there's a serious risk that this actually does break out, and similarly, some unexpectedly hawkish moves from the Fed would definitely see the Dixie probably break out here, and that would mean some more pain for assets in general over the coming months. Moving on, so we have to also highlight here that risks of a major deleveraging or some kind of a liquidity crisis, like we saw most recently in March 2020, has risen over the last couple of weeks. Most importantly, we've had a massive swing up in commodity prices, as most people are aware, and this actually coincided with some bond market distress signals that are pretty serious. So thankfully commodity prices have come back a little bit this week, but remember, fixed income assets, bonds I should say, they really rely on achieving a greater return than inflation, right? So if they're not, it's going to be really hard for asset allocators to justify holding them at all. So it's no accident that we've seen a real massive spike in bond market volatility. In fact, bond market volatility has not been so severe since March 2020. I'm showing here really quickly a 10 to 2 year yield curve chart. It's important because an inversion has it's close to inverting. It hasn't inverted yet. Has preceded almost every major recession, right, since World War II. This is because it causes liquidity crunches. Banks can no longer easily finance their longer dated securities with short-term debt, which is the key to their business model. Really quickly touching on OnChain more generally, we need to remember that while the Bitcoin market in particular is in a different situation from where it was in March 2020, and that less of the supply is held by short-term holders. Remember, we talked about this in the last video. These short-term holders help to fuel the significant short-term sell-offs. I still think it's good to draw attention to the market realized price. So we see here market realized price currently sits at 24,000. This means that the market can sustain an overall level of profitability until it were to break down below 24,000. This did occur in March 2020, and BTC did break down below there, at least momentarily. I'm not saying this is going to happen again, but it could serve as a useful way of understanding the types of swings that this market could expect in a liquidity crunch if it were to hit Bitcoin as hard as it did back then. Obviously, some on-chain indicators that we've been talking about, noticeably the dampening in short-term holders selling off in these crashes over the last 12 to 18 months, indicates that perhaps it could fare the next liquidity crunch a bit better, but we still have to be ready for anything. And so a good heuristic is this market realized price. But that's it for this week, everyone, and thanks for tuning in. Talk to you next time. Bye.